Welcome back to the Daily Crypto Roundup. Today's market is being pulled in two very different directions at once. On one side, Michael Saylor's strategy has bought another 3,273 Bitcoin. Bitcoin funds have just taken in $933 million. And crypto ETF assets have reportedly climbed to their highest level since February. On the other side, Bitcoin is facing a brutal philosophical fight over whether old, dormant coins, including coins believed to be linked to Satoshi, should ever be moved or reassigned in the name of future security. Then, over in XRP, Ripple's David Schwartz is pushing back against claims that he misled XRP holders, while in France, authorities have charged 88 people as physical attacks against crypto holders continue to rise. So this is one of those days where the market is not just about price. It is about institutional demand, Bitcoin's identity, XRP community trust, and the very real security risks that come with crypto wealth. Just before we continue, this episode is brought to you by Kraken, our official exchange partner. If you want a straightforward way to buy, sell, and explore crypto, Kraken is well worth a look. It's not financial advice, but if you want to check out the platform, use our link in the description. Not investment advice. Crypto trading involves risk of loss and is offered to U.S. customers through Payword Interactive. View legal disclosures at kraken.com. And remember, we are still running the XRP giveaway angle as well, so if you want to support the show, check out Kraken through the link, follow the podcast, and keep an eye on the comments and descriptions for the latest giveaway details. Let's start with Michael Saylor, because Strategy has made another Bitcoin purchase, and this time it has added 3,273 Bitcoin as it continues moving toward its long-term 1 million Bitcoin target. That number matters because Strategy is no longer just a company with Bitcoin on the balance sheet. It has effectively become one of the biggest publicly traded Bitcoin accumulation vehicles in the world. Every time Strategy buys, the market reads it as another signal that Saylor is still committed, still aggressive, and still treating Bitcoin as the company's core treasury reserve asset. It also reinforces the idea that Bitcoin supply is being pulled into stronger hands over time. When a public company keeps buying thousands of coins, those coins are not being day traded in the same way retail coins might be. They are being absorbed into a long-term corporate strategy. But there are two ways to look at this. The bullish view is simple. Strategy keeps buying. Bitcoin supply is limited. Institutional products are taking in capital. ETFs are growing. Long-term holders are accumulating. And if demand keeps rising while new supply remains restricted, that creates a powerful structural setup. That is the clean bull case. The more Bitcoin gets locked into corporate treasuries, ETF wrappers, and long-term wallets, the more sensitive the market can become to fresh demand. The more cautious view is that Strategy's Bitcoin buying has become so large that the market now has to watch the funding model behind it. Strategy is not just casually buying Bitcoin from spare cash. It has used financial engineering, equity issuance, preferred stock, debt-style instruments, and market confidence to keep expanding the position. That can work incredibly well when Bitcoin is rising and investors believe in the premium. But it also means the company is deeply tied to Bitcoin sentiment. If Bitcoin rises, Strategy can look like a leveraged masterstroke. If Bitcoin falls hard, questions around dilution, obligations, and market premium can return very quickly. So today's purchase is bullish, but it is also another reminder that Saylor's Bitcoin bet is now one of the most important corporate finance experiments in crypto. And that takes us directly into the next story. Bitcoin funds have reportedly taken in $933 million, while crypto ETF assets have climbed to their highest level since February. That is a major signal because ETF inflows are one of the clearest windows into institutional demand. Retail excitement is one thing. Social media hype is one thing. But when funds are pulling in nearly $1 billion, it tells you there is still serious capital looking for Bitcoin exposure through regulated traditional market products. This is important because ETFs change the structure of the Bitcoin market. Before spot Bitcoin ETFs, a lot of investors had to choose between self-custody crypto exchanges, trust trading at premiums or discounts, or futures-based products. Now large investors can access Bitcoin through familiar brokerage and institutional channels. That lowers friction. It makes Bitcoin easier to allocate to. And it allows portfolio managers to treat Bitcoin less like a strange outside asset and more like a liquid macro instrument. But there is another side to ETF inflows as well. They can make Bitcoin more connected to Wall Street. That is not always bad. It can bring deeper liquidity, bigger buyers, and more legitimacy. But it also means Bitcoin may increasingly trade like a risk asset during macro stress. If investors are adding Bitcoin exposure through ETFs, they can also reduce exposure through them as well. So inflows are bullish right now, but they also make it even more important to watch stock market sentiment, bond yields, the dollar, and liquidity conditions. Bitcoin is becoming more institutional, but institutional demand comes with institutional behavior. Now let's move to the story that could create one of the biggest Bitcoin debates of the year. A longtime Bitcoin developer reportedly wants to fork Bitcoin and reassign old coins, including dormant coins believed by many to be linked to Satoshi. The community reaction has been brutal, with some calling the idea theft. And honestly, you can see why this story has touched such a nerve. Bitcoin is built on property rights, immutability, and the idea that nobody can simply decide to take or move your coins. So any proposal that even sounds like reassigning coins immediately hits the deepest nerve in Bitcoin culture. The argument behind proposals like this usually comes down to future security. One of the growing concerns around Bitcoin is quantum computing. If quantum computers eventually become powerful enough to break certain cryptographic protections, old coins sitting in vulnerable address types could, in theory, become exposed. And because Satoshi-era coins are so famous, so valuable, and so dormant, they sit at the center of that debate. The question becomes, should Bitcoin ever make a proactive change to protect old coins, or even force a migration? And if coins do not move, should the network eventually treat them differently? For Bitcoin purists, the answer is obvious. Absolutely not. If you start reassigning coins, even for what sounds like a security reason, you break one of Bitcoin's most sacred principles. The network is supposed to enforce rules, not morality. It is supposed to protect ownership, not reinterpret ownership. If someone loses keys, those coins stay lost. If someone refuses to move coins, that is their choice. If Satoshi's coins never move, that is part of Bitcoin history. The moment developers or users coordinate to reassign dormant coins, critics argue you no longer have Bitcoin as originally understood. You have governance by social pressure. But there is a more complicated technical debate underneath it. Quantum risk may not be urgent today, but Bitcoin has to think long-term. If a credible quantum threat emerges, the network may need upgrades. The challenge is how to upgrade without violating property rights. There is a massive difference between giving users tools to move to safer address types and forcibly deciding what happens to coins that stay dormant. That is why this debate matters. It is not just about Satoshi's coins. It is about what Bitcoin is allowed to change, who gets to decide, and whether the social layer of Bitcoin can ever override the ownership layer. And that is why this story is so explosive. Bitcoin's value is not just code. It is trust in the rules. It is trust that 21 million means 21 million. It is trust that your coins cannot be seized because a committee decided they were inactive. It is trust that the system does not bend around powerful personalities, even developers. So whether this proposal goes anywhere or not, the backlash itself is important. It shows that the Bitcoin community is still extremely defensive around the core principle of property rights. Now let's shift to XRP, because Ripple's David Schwartz has rejected claims that he misled XRP holders. This comes after old comments from 2017 resurfaced, where Schwartz discussed XRP liquidity and price levels. Some critics argued that those comments were used by parts of the community as evidence that XRP was designed to reach extremely high prices. Schwartz pushed back and said the comments were about liquidity mechanics, not a promised price target. In other words, he was explaining how price, market depth, and large transaction settlement could relate to each other, not telling holders that XRP was guaranteed to hit some massive future number. This is a classic XRP community tension. XRP has one of the most passionate holder bases in crypto, but that passion also means old comments get analyzed, clipped, reshared, and sometimes turned into price narratives years later. Schwartz's original point was basically that if XRP were used to move very large amounts of value, it could not remain extremely cheap forever because the liquidity requirements would not make sense. But that is different from saying XRP must hit a specific price. Liquidity theory is not a price promise. Market structure is not a guarantee. And that distinction matters. For XRP holders, the real takeaway is that fundamentals and narratives are not the same thing. XRP may have a serious use case around payments, liquidity, and settlement. Ripple may continue building institutional relationships. XRP may still benefit from regulatory clarity and broader adoption. But none of that means every old comment from a Ripple executive should be treated as a coded price prediction. That is where communities can get themselves into trouble. They turn analysis into prophecy. At the same time, Ripple executives also know how much weight their words carry. When someone like David Schwartz speaks, the XRP community listens closely. That means clarity matters. If comments are technical, they need to be understood as technical. If they are speculative, they need to be labeled as speculative. Because in crypto, especially with XRP, a single sentence can become a multi-year belief system. Schwartz is now trying to draw a line between explaining liquidity needs and promising future price performance. That is a necessary line to draw, even if some holders do not like it. Finally, we need to talk about the darker story out of France. French authorities have charged 88 suspects, including 10 minors, over alleged crypto wrench attacks targeting crypto holders. Prosecutors say 75 of the accused remain in pretrial detention, and the cases are connected to multiple investigations in Paris. This is one of the most disturbing trends in crypto because it moves the threat from online hacks to real-world violence. A wrench attack is when criminals use physical threats, kidnapping, home invasion, or violence to force someone to transfer crypto. It is a reminder that self-custody is powerful, but it also creates personal responsibility and personal risk. The numbers from France are alarming. Authorities reportedly tracked 18 incidents in 2024, 67 in 2025, and 47 so far in 2026. That is a serious escalation. Security experts have also warned that public displays of crypto wealth can make people targets, especially when criminals can connect online identity, social media behavior, and personal data. This is why operational security matters. If you are posting wallet screenshots, bragging about gains, showing expensive purchases, or making it obvious where you live and how much crypto you hold, you are creating risk. And this is a message that needs to be said more in crypto. Security is not just about seed phrases. It is not just about hardware wallets. It is not just about two-factor authentication. It is also about privacy. It is about not making yourself a target. It is about not telling the whole internet what you own. It is about separating your public identity from your financial life. Crypto gives people sovereignty, but sovereignty without security can become dangerous. As always, this is not financial advice. Crypto trading involves risk of loss. Keep your security tight, do your own research, and never invest more than you can afford to lose. Drop your thoughts in the comments, smash like, follow, and we will see you at the top.